This stupid simple strategy made me $4.5 million, and I'm about to show you how. It's stupid simple, and the best part is, it appears every single day. Today, I'll break down the process that I use to make millions of dollars into 3 simple steps. So, every day, I use the same 2 levels to trade from. Either previous day's high or previous day's low. Now, let's talk about context behind both of those. So, ideally, what we're looking for are important daily levels that we're possibly going to trade to in the future. So we have previous day's high and previous day's low. Now, how we trade to these specific levels is how I try and position myself. So let's say if I'm bullish, and then we have a specific day, and let me just draw out a candlestick here. So let's just say that this day closes like this, and I'm bullish. And just pretend that this shaded candle is green. Well, the next day, what I'm looking for is a raid on this previous day's high. So if I draw this out here, I'm looking to target previous daily high, or it might be another daily high that's further back in history. And I'll get into some of the chart examples later on. But very short term, I'm looking for this previous daily high. So what I'm looking for in an ideal situation is if I can position myself prior to this high being ran out. So if I come to the charts in the morning and it's already ran above the previous daily high, my trade probability goes way down. So I want you guys to write that down. If we are above, if we already trade to previous daily high, probability goes down. Why? Because this is my daily target. Now, if the target's already been met by the time I sit down in front of the charts, that is not an ideal situation. So what I'm looking for is to position myself somewhere lower here to target that previous daily high. Now, I'm going to draw this out for you guys. It doesn't need to be the high from 24 hours ago. We could have a previous daily high that's way back here. You know, maybe this is 10 days ago, maybe it's 20 days ago. And then we are starting to slowly trade towards that level. And now all of a sudden, this previous day's high becomes our target. And what I'm going to try and do is position myself prior to the run on that previous daily high. But just from an intraday standpoint, this is typically how I look at markets. When I sit down in front of the charts, I want to know if we've rated the previous daily high or the previous daily low. So if I am bullish, I prefer that we're trading like this, leading up into a time window. Now, that time window can either be London or New York session, but for me, an A+ setup would pan out if we are below the previous daily high and we haven't yet taken it out, because this allows me to position myself right prior to the target being met. Now, if I come to the charts again and the target's already been met, well, now I am chasing price and I'm not getting the most efficient entry or the best probability. There is too much risk after taking out this previous daily high, right? And vice versa, if I were to draw out a bearish candle, let's just assume that this is a bearish day, and I'm assuming that we are going to take out the previous daily low. Well, again, in an ideal scenario, I want to position myself where the market is somewhere up here and I'm targeting this low to then trade lower. Now, again, if I come to the charts and the market's already down below the target, I typically will not take a trade. You know, maybe I might wait for a bounce, and then this creates another daily low, and I can position myself somewhere up here prior to a run on another daily low. So for me to establish a proper trade idea, I need to have a strong conviction of which previous day's high or low I want to target. So if I run through my charts, I want to be able to pick a old daily high or low that I believe the market is going to trade to as my target. If I don't have a very clear indication of where the market might trade to or where it wants to trade to, then oftentimes I'm just sitting still waiting for more information. So first item on our checklist when I sit down in front of the charts, is there a previous daily high or previous daily low that the market wants to trade to? This is really the basis of how I come up and establish trade ideas. Again, trading is about having a proper plan, preparing for the marketplace prior to you sitting down in front of the charts. Because I can tell you how many times I've sat down in front of the charts without a plan, and then all of a sudden I find myself taking trades in all different directions, not having a clear entry or exit strategy, and I find myself bouncing back and forth between trade ideas. And you can obviously tell in your equity curve when you don't have a plan and you're not following that plan. So a very simple process that I do is I just sit down at the close every single day and try and determine if the market created a higher high or higher low compared to the previous day. You know, is the market trading in one specific direction, and any adverse price action really is just a pullback for me to possibly buy dips, you know, or short rallies as the market's going lower. And here's a big asterisk. I very, very rarely change directions after I've done my analysis from the prior day. So if I'm assuming a bullish scenario for the following day, I very, very rarely will take a short entry on the low time frame. All right, so having these levels alone won't make you a profitable trader. And in order to do that, you need to know how to avoid getting faked out. So if you're looking for a simple framework on how I frame my trades and operate day in, day out, make sure you download my free PDF. I'll leave a link to that in the description. Now, if I gave you a trick that helped you avoid losing trades, are you the type of person to use it consistently? If the answer is yes, then this could be your breakthrough that you're looking for. And you've likely heard of it already, but you're probably using it all wrong. And it's the power of three. So what exactly is the power of three? So the power of three really is just accumulation, manipulation, and distribution. So in the terms of a daily candle, typically what we're looking for is a range to be built up. Maybe this is the Asian range, maybe this is the London range. And what we're looking for is, if we're bullish, we want to be able to see a raid on that liquidity as manipulation. Okay, so this is our accumulation. The raid on liquidity is manipulation. And then distribution will occur when we run the other side of the range and trade towards the predetermined high time frame target. So here we have a range, which is accumulation, manipulation to get people suckered in on the wrong side of the market, and then distribution as they pile in. So they'll pile in, accumulate their orders, and they'll distribute those long positions as the market trades higher. So I want you guys to think about this, and this was really a light bulb moment in my trading. 99 or maybe 95% of bullish candles start out bearish, and 95 to 99% of bearish candles start out bullish. So time is a very powerful aspect of my trading. And when I'm thinking about trading sessions, okay, I'm just thinking about maybe a 4-hour candle or 1-hour candle. We're going to divide that candle into fours. Okay, so usually the beginning of that hour, okay, is going to end up being some type of accumulation. Okay, and what I'm looking for is a run lower, right, around a specific time. So maybe it's the first 15 minutes. Okay, so if I were to break up an hour, right, there's 4 15-minute candles in that hour. Now, if I see the first 15 minutes trading lower and I'm bullish on the day, and I'm expecting that next hour or that next 4-hour candle to trade higher, I want to try and position myself at a discount, right? Maybe we have a market structure shift or a fair value gap somewhere down here after we've taken out this liquidity. Now, this might occur around the first 15 minutes or the first half hour of a specific trading session. And yes, it can lead up all the way till the last moments of a candle. And you guys have maybe seen it. You're looking at a 4-hour candle. It looks extremely bearish. And then maybe in that last half hour, last hour, the market just completely turns around and it catches you off guard. But if you were to go back and study that data within that 4-hour time frame, okay, you would have seen something like this occur, where they're accumulating a lot of orders. They're manipulating it lower ahead of the close. And then by the close, it might trade much higher. Now, as long as this aligns with our higher time frame analysis, this is essentially power of three. So you're probably wondering, you know, how do I implement power of three in my trading strategy? Well, all of my trading will start with the midnight open. So I use the midnight open as kind of my barometer of how price is trading on a specific day. And some of my best trades have come when I'm aligned with that higher time frame. So let's say I'm assuming this specific day, I want to see price trade higher. Well, any price that I get or any price action that I get below the midnight Eastern line is going to be much better price action for me to place my long position. So let's say if I place my long position down here versus if I waited for a long position up here. If I were to measure the risk to reward that is currently being framed, if I do not get the price below that midnight open, you guys can already see that I am not getting any better risk to reward. Down here, I can find a market structure shift, place my stop there, and be okay that the daily candle is going to flip bullish and close higher on the day. Whereas if the candle has already flipped bullish, I may have already missed out on the best price of the day. So when I sit down in front of my charts at New York session and we're already trading higher, I have a very hard time putting on full size positions. Because I've seen too many times where I'll enter a long position right around New York session and it'll trade back to midnight open or even lower, taking out the Asian range lows before it goes higher. So when I'm looking at the actual price, the closer I can get to midnight or below, that's when I'm interested in price action if I'm bullish. And if it's above, I trade with very small size or tight stop losses because I know that the risk to reward is not as favorable if I were to position myself down here. Okay, so now let's just assume that we're looking at this chart and we've ran above this important previous daily high. Now note that this is not, the previous 24-hour high. This is a significant high in the markets. And I'm still looking at this previous daily high as buy-side liquidity. And I just want to monitor price action as we've hit that high time frame liquidity. So what do we get on these specific days? Well, we've pushed higher, and then all of a sudden we get an inside candle. Now, inside candles to me spark indecision. So an inside candle, right, is a candle that does not take out the previous daily high, and it does not take out the previous daily low. So this is consolidation. Once we get a break out of that consolidation, right, what do we get on this next daily candle? We get a lower high and a lower low. So coming into the next 24 hours, I am leaning bearish on that specific day. So if I just draw out the previous daily high and the previous daily low, what I'm looking for is some level of premium to then target this previous daily low. Now, when I'm bearish, I want to see all these high time frame arrays fail. So if I'm bearish and the market is trading higher on this specific intraday, so let's just say I'm bearish and this is the start of the new day. Well, then new day opens up and any bearish PD array that shows up, I want to see if there's a reaction from those specific levels to roll over, and then I can target this previous daily low. So even if we take out the previous daily high, I am still hunting a short position to then target the previous day's low. So if we just play this one candle forward, you guys can see here that after we've taken out that previous daily high, I'm sure I can go down into a much lower time frame. Okay, we've taken out this previous daily high here. You guys can see the market roll over extremely aggressively. And then all I'm doing is targeting Thursday's low. So what I want to see here after taking out the previous day's high is that we don't expand higher. So after we've taken that previous daily high, I do not want to see it continue expanding higher. What I want to see is a closure back below that previous daily high. And then you might use something like a turtle soup or a inverted fair value gap to signal that short position, and then you could possibly get short here. Okay, so now what do we do in this scenario when we have a very strong daily close here? Now, if I were to just plot this previous daily low, it doesn't really give me a great risk to reward trade. So what I'm going to try and find is where is the next previous daily low that I'm going to target? And the next previous daily low is going to be here. So on this next day, what I'm expecting is just a very short and shallow run, maybe higher, and then targeting this low. So let's play this candle forward. So as you guys can see, these bearish candles, right, start out bullish. And this is where a lot of traders get caught off guard, is they see price action trading higher on a specific day without realizing that it's only doing this to get people off sides. And this is where a lot of traders mess up because they lose sight of where the market is actually going on a high time frame. So let me just draw this out. From a power of 3 standpoint, I'm going to make these lines blue here, just so you guys can visually see it. Note how in a bearish scenario that the market wants to trade higher initially before going lower. Anybody that's shorting it above that midnight open is getting a much better price than if they were to wait for it to dump off and then position themselves short. Now, there's nothing wrong with getting in a little bit late after the market has already tipped its hand, but just realize on specific days where you're seeing a specific framework pan out and it's offering you a good price, that you're going to find much better risk reward trades because this power of three scenario is panning out. So again, if I look at this price action on these two specific days, and if I just remove this, where are the smart money players positioned inside of these candles? Okay, they're positioned inside of these wicks. Ideally, if you're bearish, you actually want to see the market trading against your predisposed position. You actually want to see it going against you so you can position yourself somewhere at an efficient price with low risk to reward to then continue trading to these previous daily lows. All right, now that you understand what levels to trade from and how to avoid losing trades, let's tie it all together into a strategy to find your trade entry, stop loss, and target. Okay, let's just take a look at some of these examples here where maybe we're expecting previous day's lows to get hit. Okay, so let's just draw out this previous daily low and say that this is going to be my target long term, or at least maybe over the next couple days. What I'm looking for are different bearish entry signals or bearish criteria to align to get me in sync with that lower time frame price action. So that might be a raid on the previous day's high and then a smart money reversal. That might be a bearish fair value gap. It might be a bearish breaker, something along those lines to eventually get us down to these previous daily lows. So here on this specific day, right, on Monday, we can see here that we've taken out Thursday's high and rejected and then created a fair value gap. Maybe you didn't short this one right away, but your target is still this previous daily low. Well, what I'm going to do is drop down into these lower time frames. And for me, the lower time frame, really, I typically like to start with the hourly. If I can find really clean hourly levels, I tend to stick with them. When I have a target in mind, I don't always need to hold it to my target. I can close based on time of day. So let's just say you want to trade this bearish fair value gap here and target this previous daily low. Well, what I'm going to try and do is when I sit down in front of my charts, right around 9:30 a.m., because this is NASDAQ, we have equities open at 9:30, I kind of am waiting for more information. And this 10 a.m. into 11 a.m. candle is giving me that information. It's trading up into this fair value gap and it's closing bearish. Now, if I were to go short, I would want to just go short here and place my stop at a logical area. Maybe it's 50% of the fair value gap. Maybe it's the high end of the fair value gap because it is kind of wide. And I really am just targeting, maybe I am going to target the previous daily low all the way down here. Now, you guys can see that if you're a futures trader, you would not be able to hold this position overnight. Now, for me, time of day exit is extremely important because you might not get the follow through leading up into the rollover. So if I were to go short here, I'm trying to manage my position ahead of the close. Now, that might be lunchtime, that might be afternoon session, somewhere around there. I'm looking to manage the position because I'm assuming that the intraday high or low is already printed in the marketplace. So if I were to position myself short, I'm really only expecting that next 4-hour candle to trade lower, and maybe I'm going to close it towards the end of that 4-hour candle. So you guys can see here that this candle closes at 2 p.m. This is the closure of that 4-hour candle. So if you get an expansion lower on the 4-hour candle, you can think about just trimming your position, managing your stop loss, or just closing entirely. So based on this specific trade, at most, it offered you a 2.3 to 1 reward to risk. Now, you might not get all of that out of this specific trade. Maybe you're going to get a 1.5 to 1, something a little bit smaller, but this is still a profitable trade. Now, coming into the next day, let's say our daily target still is all the way down here. I'm still expecting the market to trade higher. Now, let me draw our midnight open prices here. So on this specific day, I'm still expecting the market to trade down to these lows down here, right? And as this market is trading higher, all I'm looking for are reasons to get short. Okay, I'm not taking any bullish setups. Okay, so if you see this bullish fair value gap here, I'm not taking that setup because I am bearish overall. If I just look at this price action from yesterday, right, I just looking at footprints. So the footprint of this market is we have a consolidation and then we have a markdown. So this large distribution here, I do not want to try and go long into this because there are signatures that the market is bearish. So that following day, I am only looking for reasons to get short. Now, as the market's trading higher, we're approaching the previous day's high. Now, if we are expecting the market to create lower highs and lower lows on the way down. We are not expecting this previous daily high to be rated. Instead, maybe it's going to trade to this bearish fair value gap, or you can see this up here as a bearish order block. So this last up close candle prior to the move lower is our bearish order block. Or you could possibly see this here, this liquidity raid. Now, once we have that bearish narrative, all it's about is positioning yourself with a setup that you're comfortable using, whether that's a fair value gap, an order block, a liquidity raid. Those are all different entry techniques that you can use to get in sync with the market. Now, I don't recommend that you guys try and learn all of the techniques all at once. Try and just find one entry model that you're really comfortable with and continue trading that specific model, and enough reps around that specific trade setup that allows you to be very, very comfortable with it. For me, I've traded thousands and thousands of turtle soup entries, so liquidity raids. I've traded thousands of fair value gaps. I've traded thousands of order blocks. I've traded thousands of breaker blocks, and I'm very comfortable trading all of them, which is why I trade all of them. But initially, I wasn't. Initially, I was trading liquidity raids and failing at them. Initially, I was trading fair value gaps and failing at them. And it's just about getting reps and experience and having trust in this analysis and positioning yourself in a way that's going to provide profitability. All right, guys, so tying this all together, again, what you're looking for is to have a daily direction or a high time frame direction. And again, you should have a very strong conviction of where the market is going to go before you place any trades. Then the next piece of the puzzle is making sure you're getting a proper execution on that daily time frame. So I'm going to put proper power of 3 execution. I'm going to put an asterisk here and say, if market has already expanded in your direction when you sit down at the charts, trade small or not at all. And why is that? It's because the risk to reward is no longer skewed in your favor. So again, timing of these trades is very, very important. And timing can be the difference maker between you being a profitable trader or you being a losing trader. In my ideal scenario, if I'm bullish, I actually want to see manipulation lower during New York session to position myself long prior to the run higher. And I'm going to show you guys a very quick example of that. On all of these days that the market has traded higher, if you just look at all this intraday price action, right, you might get faked out by all this price action being traded lower. But you guys can see here that it's really just retracing back to the midnight open. So each time it retraces back to the midnight open, now I don't think I have the exact midnight open. You guys can see here that each time it retraces to the midnight open, as it's getting in here, it's getting bought up aggressively because they're trying to buy it close to the midnight open. They're not trying to buy it all the way up here, right? Up here is just reaccumulation, but they're accumulating initially down here after running out this low time frame liquidity. So they're accumulating their longs below the midnight open for that run higher. Now, if the market's already up here, right, your risk to reward goes down. Even though this trade did pan out, you could put your stop loss here. The risk to reward is not as good as if you got in, let's say, down here. Okay, compared to here, your risk to reward is not as good. So like down here, I can put my stop loss down here. Here though, I don't know where to put the stop loss. If I go long here, my stop loss might need to be all the way down here, right? So it's not offering you the best risk to reward opportunity. Here again, you're looking for the market to trade against you, right? Towards the midnight open. Try and position yourself near the midnight open for that run higher. Again, the following day, this, lots of manipulation, just taking out the Asian range low. Here's our midnight open here. You guys can see here that it just goes to the midnight open. This is where we want to position ourselves for a long idea. And then it goes higher. Again, here, this move down here, just manipulation before it runs higher. So again, if I'm bullish, the closer I get to that midnight open or below, the better my chances are of finding profitability on that specific trade. And then when it comes to intraday execution, I want you to avoid all trade setups that do not align with high time frame direction. And then finally, I want you to do an analysis of the prior day's price action. And very simply put, who won the battle, right? You can visibly see who's winning the battle every single day. Even though intraday price action is telling you the market is going lower, How did the day close? It closed bullish. How did this day close? Even though there's some intraday price action lower, it closed bullish. You can see the majority of price action closing bullish. Even this day, right? Even though this thing ran lower, it still closed higher compared to where it was at midnight. So this is still a bullish day. This, even though it ran lower, it still closed higher. Now, I know this is a lot to take in, and for me, this is simple, and I've tried to break it down as simply as I can. But if you need extra help and want a mentor to be right there with you when it's time to execute your trades, guiding your hand and correcting your mistakes, I'll leave a link in the description to apply to work with me. This isn't for everyone, as I can only work with so many people to keep the quality of the mentorship high, but for serious traders who are looking for real professional help, click the link to apply. You now have a stupid simple strategy that appears every single day. Remember though, trading is not easy and it's gonna take time to master this. So if you like this video, then you'll love my free course here on YouTube. You can click the button on the screen to watch that now. Also, make sure to subscribe and I'll see you guys in the next video.